So I've been watching a lot of CNBC, and I do have some opinion about the market and the economy and the stock market. Uh, is it all this opinion is coming from watching CNBC? Uh, I think I've been watching also a lot of price actions in the chart and spending a lot of time analyzing, what's happening in the last few months and having myself trading and feeling the pain in a lot of stocks as well as gaining from it. So, my takeaway is that there are two kinds of forces who really drive the market these days. One is a quant who actually runs the algos, and the other is the traditional investors who would invest large amount of money based on macros or fundamentals for the stock. Now, at this point, obviously, the buyers, you'll find less buyers than the sellers, or rather, the sellers and buyers are also kind of now in a limbo. So the traders are really driving the market. So if you're a quant investor or if a quant who is uh, who is running the algos, you would not care about really what the fundamentals are. You're really looking at the news and the technicals. As the news are pretty often, breaking in various channels and various forums, Twitters, etc. So the quant first thing they do is start selling or start buying, and that'll trigger technical level, whether it's a Fibonacci or is a 200-day or 50-day or 100-day moving average or the Bollinger Bands, RSI, whatever it is, that would trigger buying or selling, and that happens instantly without the retail investor would be able to even react to it. If you are a fundamental or the big investor who are looking at buying like millions of stocks on a day at the close, like a Vanguard or like a Fidelity, then you are right now you're not really allocating funds. You're holding the cash and you're waiting for the right time. Some of the cases you might be actually just buying a little bit, and in some cases the buyback from the companies that would be also triggering, but that is they would just trigger it seasonally, and it wouldn't it has usually no consequence because they are the buyers at the dip, but they're not really moving the market that much in this volatile market. You might be getting trading opportunities, knowing that certain companies will be doing buyback, let's say right after their earnings for the next 1 month or so. So usually that's why after the earning, the stocks will move up, move higher. But there is no guarantee that that will continue. The momentum will continuously go down. So in JS, there are three kinds of forces. One is the fundamental, the investors who are buying based on the macro and the stock fundamentals. There are quants, and there is a buyback program. So for real investor, you're really in a tussle that when do you get in? So my take is that looking at the price action for the last several, I do options. I do sell put options. Very rarely I do buy call these days. I mean, almost never unless I can do the risk reversal. So I sell a put enough so that I can finance the call. That also very rare because almost always you lose money on the call because of the high premium, high volatility. And if I do the buy the call, I'll not wait until the expiry date. As soon as I get some profit, 20%, 30%, I'll close the call. But selling put has been beneficial for me, except when I get like most investors, I get fear actually comes into picture when the stocks get written, and I know I get assigned those stocks by selling the put, and sometime I'll take the loss. In the past, I have an issues not taking the loss, and actually, I had incurred a lot more loss. So these days, I do take loss as I needed to hit the stop loss as soon as I can. So then the question really is that as a retail investor, what do we do, right? Like there's a fantastic opportunities you can buy that if you look out like 3 or 4 years down the line, you would say that these are good companies. Take any ARK, ARKK, the cathode stock, right? These are all good companies. These are not like these are all like snowflake kind of companies in that space wherever they're working on. But the stock valuation was crazy, right? And they're not making money, and they don't have a Warren Buffett supporter, and that's the reason why they're getting killed so much. Whereas Snowflake is not. Snowflake revenue is 500 million. It's nothing, so they're supposed to grow, but every time there's a dip, is getting bought because there is a buffet, and then there is people who are kind of looking at this nice news events or on a buffet stock. Other companies, there are like hundreds of those growth companies. Everybody says and come in CNBC and said, don't buy growth. But if you look at, there's some Tom Lee, he said, which I actually resonates very well with what I think at this point is that, everybody talks about the valuation, the S&P valuation of 17 or 16 historical. Now, that historical valuation started from 1930s, and it went all the way during this, until 1990s, when the interest rate was around 10%. So if you had a 10% interest rate, you're getting, like 10% return of your capital, and you have a 50-50 sort of portfolio. Obviously the stock would have a lower valuation, so 16, 17. When you have the interest rate at 3% or even 0% a few years ago, last year even, at that time you have no alternative. You have to have a higher valuation. So 22. If you look at the S&P valuation for the last 20 years, you'd see that most of the time it was around 20 to 23. Only in a couple of years, 2018, 2014, and I believe it was 2016 as well, it was around 16, 17 range. Only at the recession level, it gets to 15. We're not in a recession, and we're not going to go back to the 16, 17 valuation as long as the bond stays at 3-4%. 3-4% was in 2000 when before the 2008 financial crisis. That's where the 10-year bond was around 4%, 4.5%. So since then, it was always zero. So at that time, the evaluation was above 20. 2000, the S&P was at 30. So if you consider the PE, as Tom Lee said, for 3.5% 10-year yield, you get around 35 PE, versus in stock, you're looking at 19 PE or 18 PE today, trailing. Forward looking, maybe 17. So these are cheap stuff. You can easily go to 2021 as a historical basis for the last 10 years. Let's give it 1920. You still have, for $220 of S&P earning, you get around 4,400. So stocks are cheap. So going back to the point of what the retailer should do, doesn't matter if you are looking at technicals, because everything is below the 200-day moving average. Even some of them are below $100 moving average, 100 days moving average. And if you look at fundamentally, like what's the valuation, most of the stocks are below the S&P valuation, the good stocks. So these are buying opportunities. So the question becomes that what do you do? Do you take the pain, or knowing that you're not seeing the bottom, and listen to the experts, waiting for 3,300 to happen, and at the time 3,300, you'll be definitely seeing that your buying ability will be squeezed down, because all the stocks are down, so your leverage will be much lower than today. If you're holding cash, then it's a different story though. But are you waiting for it, or you don't know like what's gonna happen for sure future? So my tactics has been that hold cash, sell put at the lower premium, and always look at the technical. The technicals are working like a routine in the last 3 months or so. So you follow the 15 minutes or 1 hour chart or the daily chart, and you hold the trade for more than about 2 weeks. If you're making loss, do not sell. Hold for 2 weeks. The market will swing. Trust the market will swing. And don't stay away from the stock. The Fed is not stupid. The stupid people really here are who are coming to CNBC. They're selling ETF, and they're telling everybody that don't buy technology, don't buy growth. What do you mean by don't buy growth? That what really they mean, don't buy ARK, don't buy technology, means that they start selling the ETF. And that's why they're saying don't buy technology, because the ETF wise, what happens is totally different story versus individual stock. If you look at the XLF in 1990 to 2022, the return of the XLF is below the return of the S&P. Why? Because during this period of time, the interest rate has gone down significantly from above 10% to almost zero. Bank would not make money if the interest rate is this low. And that's why the overall earning of the bank has decreased, and that reflected in the stock. Now, if you're buying the XL, if you're really talking about the XLF individual stocks from the XLF, then it could be a different story. Goldman Sachs or somebody like if you look at uh, the Berkshire Hathaway, which is around 13% weight of the XLF, they did very good. But the rest of the guys, the JPM and the big banks of Bank of America and so on, they basically did not give you any return in the last 10, 12 years or even 20 years. Why? Because of the interest rate. So when you're buying the XLF kind of ETF, you're buying all this conglomerate, which some people thought at the time when they created it that this is the right weight, which does not apply today. So that's why when these experts come in and say, don't buy technology, don't buy growth, I mean, they are selling to their clients the ETF. And, that they were in the 10 years ago, what was the right investment to do because of the diversification, because, everything making money with a zero interest rate. That's what they're still doing. And they're saying that don't do it anymore because our method is wrong. So they're not saying that we're going to go back to doing the individual stock, but they're saying that we're not going to do this ETF, which is losing money, which is like technology, which is basically, in their view, is all growth. When, as an individual investor, you are actually spending time on individual stocks, looking at the charts, looking at the earnings. Don't listen to all those folks who are who have their own agenda, come and talk in CNBC so that to put the market down and up and make profit from it, because they're just like capitalizing on the name. Instead, look at the chart, look at the price action, and spend 2 weeks without buying anything on a specific chart and see how the price actually varies and follows a technical, and you'll have a good idea that what price range is good. Every time there is since this 3600 3636, the bottom, there has been ups and down in the market, but has been in the tight range. The tight range means that the buyers or seller are now in sort of like balanced, because whenever there is this Bollinger Band really compresses, that means it's a consolidation happening. So right now, as a consolidation period was happening until today, when today there was a news that came in that basically confused the market. The market now does not know that whether Fed has a control on the inflation. That was the key. So from a macro perspective, so that will mean the buy the dip mentality that would have triggered would actually has to wait until S&P is down a little bit lower. So previously maybe 3900, the folks will come in and buy because we are in the tight range of consolidation. But because of the news, now that range might have become 3800. But nevertheless, they will be buying the dip from the fundamental perspective. From the technical perspective, look at the Fibonacci series for the S&P that has been followed like a religion for the last couple of months. Today it stopped at 3982, and 3975 is a Fibonacci stop for a retracement when for this last move from 3886 to 4130 that happened today. So overall, 4110. So during that period, the next first stop is the 3986. So that's why today actually we saw the low. and it's going to go down a little bit further. But as there are more bad news getting consumed every day by the market, so the impact of each bad news will be less. It's just like the diminishing marginal utility theory, right? So basically what will happen is buy the dip will come in a probably less than a week. It could be this Friday if the market sells off in the next couple of days. So you will miss out if you listen to these investors every day, because you'll not be spending time like day in and day out every day 3 4 hours listening to this looking at the market. If you don't do that, then don't listen to also the investor and make decision based on this, whatever who says in CNBC. Look at the price, look at the 52-week low, look at the trend. And if you can dollar cost invest, like don't buy 100 stocks in one go. If you want to buy 100 stocks, buy 50 25 25 or 25 50 25, instead of going all out and 100 stocks at once. So that's a better way of doing it. The other thing is, you could trade all day long in SPY. It's range bound. So today it's going to go to around like 39.50ish. So look at the future tomorrow and see that how it behaves tomorrow, and you can easily go for follow the Bollinger Band for the 15 minutes or 1 hour and do day trading as well.